Welcome, everybody, to Value Investing Live. I am pleased to welcome our guest this week, Ben Claremon, Principal and Portfolio Manager for the Classic Value Small Cap Plus strategy at Cove Street Capital. He last joined us in January of last year. If you missed that presentation, there is a copy of it here on YouTube as well as on Guru Focus, so check it out if you get a chance after the fact today. As always, please post your questions in the live chat throughout the presentation. Please also let us know where you are viewing from, because we do love to see those international audience members out there. Without further ado, I will go ahead and hand things over to Ben.
Sydney, thanks so much. And thanks to Guru Focus for having us back. The title of this presentation is Further Adventures in Contrarian Value Investing. If anyone saw the first presentation, the title was Adventures in Contrarian Value Investing. The point being that being a contrarian and being a value investor always presents challenges, and we're going to get into why that is specifically when we just give an update on Viasat, which was the company we discussed, and then also talk about a new company briefly, which is Millicom. Here's our safe harbor. Just remember, these are not investment recommendations to buy or sell any securities. We're just talking about stocks that we own at Cove Street Capital. So here's an agenda. I like to give people a little bit of framework where we're going. Just a reminder, especially for anyone who didn't listen to the first presentation, who we are at Cove Street and who I am as a portfolio manager at Cove Street. And then I'm going to share some updated thoughts on Viasat. It's been a really, really eventful year for Viasat. A bunch of things happened that were not on our spreadsheet. I think that's almost always the case with companies, but it was a particularly meaningful year for Viasat. And then we're going to briefly go over Millicom, which is the next idea that I'm going to kind of toss out there today. And then hopefully, we will definitely save time for Q&A. So just a little bit about myself. I joined Cove Street in 2011. I've been here since day one. I've also been managing our small cap plus strategy, which is our kind of code word for SMID, since 2016. Started off on the buy side during the financial crisis, which was an interesting time to start a career. And more recently, I started my own podcast, which is called Compounders, the Anatomy of a Multibagger, where I interview public company CEOs about how they're building their businesses over time. So the reason why that's particularly relevant here is because I've interviewed the executive chairman from Viasat and the CEO from Millicom. So if anybody wants a little more information on these two companies and wants to get a feel for the management team, I have links to the interviews I did with Mark Dankberg and Mauricio Ramos at the end of the presentation. So just a little more about Cove Street. We're based in Los Angeles. We're 100% employee owned. We have about 600 million under management. We think of us as kind of like a small SMID micro firm. Basically everything we do is 12 billion and under, and we'll go into the micro world, which is 50 million and under. And we run pretty concentrated. So that's 30 to 39 stocks in our classic value small cap strategy. And then in the strategy that I manage, it's 20 to 29 stocks. I think we own 23 right now. Everything we do at Cove Street surrounds business, value, and people. So those are the pillars that we evaluate every company on, and we pay a fair amount of attention to the people. This presentation is going to be a little more business and valuation focused, mostly because we've known the people for years, and it's a little hard to communicate, decades of experience with people in a short presentation. But believe me, as we talk about Viasat and Millicom, we have a strong faith in the people as well, in addition to the quality of the businesses and the valuations they trade at. We've been pretty out there about our position in Viasat. So if you go to our website and click on podcasts and recordings, you'll see a lot of different content presentations we've done on Viasat. I linked to one of the ones here that my colleague gave a couple years ago. Things change here, but it still remains one of our largest I think our largest position at the firm. So just quickly, a little bit more about us and our investment philosophy. Classic fundamental research-driven value investing. So we do a lot of work. We try to do as much work outside of what you call traditional Wall Street sell-side diligence as possible. We think and act long-term, 3 to 5 years at minimum in the strategy that I manage. I mean, ideally, we don't think forever. We take advantage of the mathematics of compounding. We let our businesses get more valuable over time without selling them too soon or realizing taxes. We want to be long term, just like most of our companies are focused on long term. Less is more. That's a small group of people at this firm making the decisions and doing the work. Focusing on a smaller group of companies, just focus on what is really within our core competence. And as I said, we concentrate on our best ideas. In terms of companies that what we're looking for in companies, I mentioned the people side, corporate governance and rational capital allocation are hugely important to us. That topic is going to be very relevant to this presentation because both of the companies that we're going to discuss made very large capital allocation decisions in 2021. And and the trajectory of the company is going to be impacted by those decisions. And so to some degree, you have to be able to be willing to underwrite that management of both companies understands what the rationale and the returns associated with those capital allocation decisions. And the questions that we always ask for every company, is this a high return company that is getting more valuable every day? Is a company run by honest people who understand capital allocation? Again, getting the people side. And then is a stock undervalued based on conservative assumptions about the future? So mostly what that means is, buy a business that's getting more valuable every day at a slight discount to intrinsic value. So we're looking for 80 and 90 cent dollars and not 50 cent dollars that are mediocre businesses. So getting to Viasat, which was a company that we discussed when we were on Guru Focus last time. I think the title of that presentation was A Path Upwards. And the title of this one is An Irregular Path Upwards because it has been a little bumpy. And I'm going to talk a little bit about why that has been, but also why I think to some degree the opportunity is even larger than it was when we first discussed Viasat. So stocks around, I don't know, market's bouncing around, but the stock's around $47 today. Just getting to the punchline, we think it's worth 70 to 75 right now. And there's two asterisks there. And the reason for that is that's kind of like a present value, like what's worth today. We think that the path to $100 per share is doable for Viasat over the next few years as the Viasat 3 satellite launch, and assuming they close the deal with Inmarsat that I'm going to discuss in much more length in the following slides. So again, this is arguably one of the most compelling investment opportunities we've ever seen at our firm, and like last year, it's still the largest position in our small cap strategy. We have followed this company as a firm, for 20 years. So that means that even before Cove Street at our founder's previous firm, he was a Viasat shareholder and knew the management team. We think that people don't quite understand the degree of intellectual property and the uniqueness of some of their technology, especially when it comes to satellite encryption, when it comes to the ability to create high throughput satellites that have basically revolutionized the industry, and no one has been able to replicate. In fact, on a recent earnings call, if you read the EchoStar last call, EchoStar owns Hughes, which is a competitor of Viasat. They basically are throwing in the towel. They said they're not going to build any more satellites because they can't compete. The technology, they start off behind an 8 ball because they don't have the technology to compete with Viasat or people like Starlink. So it's just I think it's evidence that there's some very secret sauce at Viasat. And I think the other thing is that there's so much hype, and to some degree, the hype around low Earth orbit satellites and whatever Amazon's doing in that world and what Elon Musk is doing with Starlink, the hype is, I think, still simmering, but not quite boiling like it was. I think to some degree, some of the challenges associated with LEOs have started to emerge, whether it's from a cost basis, from a performance basis. So I think that's still an issue, and the more every day it becomes less of an issue for Viasat because less and less of their revenues will come from competition with Starlink, and I'll talk a little bit about that. And then I think the most underappreciated aspect of Viasat overall is the defense business. It really has been on a multi-year growth trajectory. The deal with Inmarsat, which I'm going to discuss, accelerates that, and everything that's going on in Russia and Ukraine right now, I think is highlights the importance of the technology that Viasat's going to be bringing to the market over the next few years. So let's talk about the last year of Viasat. So in April 2021, they closed the acquisition of RigNet for about $222 million. RigNet was focused on kind of like offshore oil and gas and marine applications for connectivity. So if you think about if I'm a rig worker on an offshore oil platform, I need connectivity to the internet to be able to communicate with whatever Houston or talk to my family. And RigNet was a provider of that. Viasat, with its Viasat 3 North America satellite that's going to be launched in the next, call it 6 months. That's going to completely change that business, because the connectivity for those individuals is going to be way faster. That's probably the better word. Way faster and way more reliable. And that means that there's a big opportunity to grow that business that they acquired. And the big event happened in November, and when Viasat pretty much out of the blue announced the intention to acquire Inmarsat for $7.3 billion. And that $7.3 billion was based on the stock price of Viasat the day of the deal, which was around 67. As I said, the stock's around 47 today. So they're basically going to be the total price is going to be less than that if you're assuming that the current stock price holds. So this deal included an assumption of about $3.1 billion of debt from Inmarsat. There's going to be an $850 million cash payment, and then they're going to issue about 46 million shares of Viasat. And when all is said and done, the private equity owners of Inmarsat are going to own 37.5% of Viasat. So this is a meaningful transaction with equity, completely changes the shareholder base. Baupost, which is Viasat's largest shareholder, signed off on this deal. So you would assume that Seth Klarman and his team looked at this pretty closely and thought it was a good deal, but they're not. Their stake is going to be somewhat diluted by this deal. The combination will create one of the largest satellite broadband companies in the world, and the company will have a leading position in in-flight Wi-Fi, which we think is a huge growth market for Viasat. But this is because of Inmarsat's extensive customer base there. The other interesting news is that COVID this should say February 2022, not 2023. February 2022. COVID is a gift that keeps on giving. The Viasat's third generation satellites were supposed to be launched already. COVID got in the way, and basically supply chain issues have basically pushed it back. And so now late summer is when we're expecting the next satellite to launch. And then there'll be 2 sequential satellites right after that. EMEA 6 months later, and then APAC right after that. So these satellites have basically been paid for. They're just kind of in the they're at different stages with testing and with Boeing, who's their partner there. But over the next, call it 12 to 18 months, we will have 3 new satellites in the air, and that's going to be a game changer for Viasat. So let's talk a little bit about the Inmarsat deal. I think it was without any question, it was a surprise to the industry, to Viasat investors, and then the stock market as a whole. The market did not love the idea, the deal at first. I think people are starting to get a little bit of a better sense of it, but at first it was, I think, people were highly skeptical of it, partially because it muddied a very clean story. Like Viasat was about to launch these long-awaited satellites that had been delayed due to COVID. The demand for satellite broadband connectivity had continued to grow, almost exponentially. And so they seemed to be really poised to capitalize on that. And, we were also going to see eventually, as people started to travel more, in-flight Wi-Fi demand come back. And then as all of this happened, Viasat was going to generate a lot of cash and delever, and it was just going to be this perfect story. And then Inmarsat deal comes in, and I think it kind of clouded the picture for people. And the other thing that I have to be very upfront about is that the regulatory approval process, especially in the UK where Inmarsat is based, is taking a while and still has a few hurdles to overcome. We personally think that the Ukraine-Russia situation almost guarantees this deal is going to go through because of the strategic importance of basically all of Europe having more of a defense infrastructure. But that is still a risk out there that we all have to contend with. So what's the like about this deal? So it's a big deal. Remember, $7.3 billion and issuing over a third of their market cap. So big swing. So the deal accelerates Viasat's international growth by providing access to Inmarsat's existing customers and distribution partners. Viasat as they were launching their EMEA and APAC satellites, we're going to have to build out a sales force and an infrastructure and ground stations. I mean, still going to have to do a fair amount of that, but this just accelerates that because they immediately, they're going to wake up assuming the deal closes and be able to talk to Inmarsat's customers and use their infrastructure to help grow the international business. So this was a buy versus build decision. And to some extent, they thought that buying Inmarsat would accelerate their ability to attack international markets. I think people thought of Inmarsat as a company with a fair amount of technology debt and that was shrinking. However, the recent results suggested otherwise. There was some one-time lumpiness in their numbers that made it look like it was shrinking. This company is owned by private equity, but they were printing some numbers. I think because they had public debt. I think that's why the numbers are out there. But the company has kind of troughed in terms of its revenues and EBITDA and has actually recently started growing. So I don't think, and I know Viasat doesn't think that they're buying a melting ice cube. I think there are substantial synergies, a fair amount of which the company cannot talk about because of the UK regulatory process. So I will talk about them. I will say, very specifically that any future Inmarsat CapEx that would have gone to their what I would call inferior satellite technology will not happen. All of the technology spend, R&D spend on new satellites will be at Viasat. So duplicative CapEx will disappear. Plus, there's all kinds of other costs and revenue synergies that will come about. But I think the company is smartly being very quiet about those. L-band is a new spectrum that Viasat does not have any exposure to. It's complementary to Viasat's core spectrum. I'm not going to get into L-band here. This is not the right environment for it. If you want to hear all about L-band, you can listen to my second interview with Mark Dankberg, who's the executive chairman of Viasat. We get into that, why that's an interesting opportunity for Viasat over the long run. I think, and this is the main takeaway from my second interview with Mark, is that the Viasat 3 technology overnight makes Inmarsat a better competitor. So you always want to make a deal as a company that makes, both companies better. But I think this is the most interesting thing that I heard and I learned about this deal is that the technology that Viasat's going to bring to bear makes Inmarsat a formidable competitor around the world in a way that they were not going to be. And so they go from being maybe a declining company or a flat company that couldn't grow a whole lot to being, to having access to the best technology in the geostationary satellite world. And so that's what I think is the important thing to recognize about this deal. But also from a free cash flow basis, what do we care about as investors? We think about free cash flow, but not just free cash flow per share. And the company has talked about the free cash flow per share projected is going to be 35 to 40% higher for the combined companies versus Viasat alone. So I think that shows that it's a really accretive deal if they can get it right. And then I think this basically accelerates their growth in in-flight Wi-Fi and defense, and really reduces the exposure to North American residential broadband, which is where they're going to be competing more with Starlink, where they're going to be competing with rural cable providers. There's just a lot more competition in that world. This Inmarsat deal really accelerates their ability to diversify their revenue stream and not have to worry about the Starlink boogeyman as much as I think people have basically as much as people have thought they had to. So what's not to like about this deal? Dilution. Viasat has had a tendency to use stock for deals. It's not something that we love as investors, but there's two ways to look at this. One, they issued stock at 67 and the stock's 47. So in some ways they issued more expensive stock to get the deal done. So the deal is not quite it won't be 7.3 billion. I guess that's kind of a small, like a silver lining here given the equity issuance, but it's something from a capital allocation perspective everyone needs to be cognizant of. Regulatory risk, as I said, this deal needs to pass the UK regulatory through the UK regulatory process. It's taking a while. There's plenty. You read the press. There's plenty of people saying it shouldn't go through. So hard to know. I think Viasat's smart, and they would never have done this if the company if they hadn't had basically. Maybe not a bright green light, but a kind of a sort of green light from regulators before even going down this path. There's a fair amount of execution integration risk. There are different cultures here. There's a UK culture versus San Diego. There was a competition versus in these companies. The former Inmarsat CEO called Viasat 3 a mythical beast, meaning that their satellites could not do what they claim to do. So there's some cultural elements in terms of the integration and that are going to be a little bit challenging. I think there's a distraction risk because they need to get these 3 satellites launched. They've been waiting to do this for years, and anything that detracts from or takes away from that focus, I think is a risk. And then there's just a base rate here of transformational deals not working well for the buyer. There's a long academic research suggesting that big transformational deals are buyers overpay, and they rarely recognize the synergy. So I don't want to pretend like we know that this is going to work out, because the base rate of success for such deals is not particularly high. I should talk about this, not just because I want to, it's particularly topical to Viasat as we're discussing the Russia-Ukraine conflict. So I think our initial thoughts and reactions are the follow. One, NATO and EU countries have not been spending on defense really at all. I think Germany spends like 2% of GDP. They're already going to double that or more, right? I just think there's a lot of room for increased demand for the kind of products that Viasat sells to its defense partners and in the allies of the US as a result of this. And the truth of the matter is that from my understanding, the Europeans do not have an infrastructure and a legacy of creating defense contractors. And so they're really going to have to buy from the US based contractors. I think what this more than anything else is going to show that the connectivity capabilities that the EMEA satellite that's going to be launched in the next 12 months will be critical to the US's allies in Europe, especially if we're going to be fighting, unfortunately going to be fighting wars in Eastern Europe, that you need any soldiers on the ground there are going to need connectivity to a degree that they do not have now, as the current satellite infrastructure cannot really handle modern warfare. What we have seen is that the Russians, without any question, used cyber attacks and tried disabling physical satellite infrastructure as part of their playbook. So I think that and Viasat dealing with this currently is that encryption in the things that Viasat actually started off as a company, 30 years ago, encryption was their core, right? It's going to be even more important. So all of those things, hardening infrastructure around satellite broadband is going to be really important, and that's something that Viasat does really well on the defense side. One other thing that this is really clear about is that if you're in a hostile area, you're not going to be able to put base stations there to relay satellite information, and so the U.S. can put, and the U.S. and Viasat can put big base stations in Poland and cover the Ukraine and parts of Russia with connectivity. If you're a LEO and you can't and you have a million satellites zipping around all the time, you're not going to be able to do that. You need base stations closer to the source. And so to me, this means that there's no way that LEOs are going to be as effective in providing broadband in a defense environment. And it also Viasat's big in basically the handheld devices that soldiers carry, and it's called the JTRS. And our European allies have none of this technology, and the U.S. has been procuring more and more of it. I think that on-ground communications is going to be even more important in modern warfare, and Viasat's going to be a beneficiary of that. And so we're not incorporating any of this into our models, but I think there's a big opportunity here for, unfortunately, it's not something we asked for, but I think there's been a drumbeat for the Europeans to think a little more about protecting their security, and Viasat's in pole position to help them navigate that. So quickly on valuation, because I want to get to questions, and I want to talk a little bit about Millicom. So there's not a pure play comp for Viasat's defense business, but these are the four: L3Harris, General Dynamics, FLIR, which got taken over by Teledyne, and then Raytheon. So right now these companies trade about 15 times EBITDA. To be conservative, we're using about 8. So they got 12.8 multiple, which is 85% of that number for Viasat. Because we think of some of the parts is not the perfect analysis here, but it is illustrative as you're trying to think about the value of Viasat. So here is the sum of the parts. So we break it up between defense, commercial SATCOM, commercial networks, and then Inmarsat, because Inmarsat is kind of a TBD, right? The deal has to close, they have to integrate it, the synergies are TBD. So we're kind of saying, let's just assume that the $7.3 billion they're paying for Inmarsat is a fair price. That's about 10 times EBITDA, not a Herculean valuation, and doesn't really, our numbers here don't even really include the synergy value that can come from it. So on a sum of the parts basis, if you include the debt that they're assuming, and the cash payment that's going to Inmarsat, we have about $36 per share just for the government business. I think that could be higher if you're willing to put, more like a comparable multiple, peer comparable multiple there, but we're trying to be conservative in general. So add it all up, we think it's worth $70, and that's right this moment today, without, a lot of the things that are going to be coming down the pipeline over the next 3 years. I think it's important to triangulate value whenever you're looking at a company. And so in this case, we also use a DCF. I would argue that satellites lend themselves to a DCF analysis. You got this big upfront spend that makes the numbers look really bad and makes you look really levered up front. And then you get a series of cash flows to help pay down debt and to generate a return. So that's kind of, I think that's a good way to value Viasat, because it is so dependent on its satellite launches. So, and it's a good way to capture the value that Viasat's adding. So, individual assumptions can bias any result of a DCF, but it's somewhat cleaner than what I would argue is a hypothetical SOTP analysis. I don't think Viasat's going to split itself up. So while the SOTP can be illustrative, it doesn't, I don't think it's going to be splitting into 3. So it's kind of just more like a hypothetical is probably the best word. And I will note that that $70 value is based today. And so 3 years out, those numbers should be higher. And so our DCF, if you use an 8.8% WACC, which is my guess higher than a lot of people are using these days, given where interest rates are, and then the growth that comes from the satellite launches over the next 5 to 10 years gets you a present value of $75 versus high 40s today. The impossible thing to model at the moment is the 1 + 1 = 3 aspect of combining Inmarsat and Viasat. It's just impossible for us to know what that's going to look like. If management's right, it's going to be a home run, and so that will never be able to reflect that on our spreadsheet right now. So I would argue that our numbers are relatively conservative. And so in general, our research suggests that investors are paying almost nothing, at the current price for the potential revenue synergies, cross-sell opportunities, and Viasat being able to access Inmarsat's customer base. Given that we're value investors, we always have to talk about the other side. There are plenty of risks here. I mean, this is a laundry list of risks. Let me just highlight some of the few important ones. Airline health is really important to in-flight Wi-Fi. So if people aren't traveling and oil costs $100, and airlines are unhealthy, that's a problem. So they need to get the cash flows that were lost during the COVID period. They need in-flight Wi-Fi to come back. So those are kind of short-term issues. These Viasat launches, things in 22,000 miles into space. And so at any point it can be hit by space junk or something like that, and a satellite can be destroyed. So that every day we wake up with that risk. And we also wake up with the risk that, satellites, some percentage, like 4 to 6% of satellite launches fail. It actually happened to SiriusXM recently, where one of their satellites basically didn't deploy properly and they lost it. Now it was insured, but they lost the satellite. So that does happen. So, you can't be too sure that this is all going to work. I think there's plenty of other risks. There's the Inmarsat Deal risk, as we discussed, and defense budgets are always questionable. Especially, I think defense budgets in Europe are going to go up, but how much can the U.S. defense budget grow is going to be an impactful thing. So there's a lot of things out here and risks that are on the table. And so the next thing I'm going to talk about is Millicom. Millicom has a company that we've owned for a number of years. It's been quite painful recently to be a Millicom shareholder. But the things I'm going to discuss are going to be suggestive of a really interesting opportunity for people who are willing to do the work today. I think the company underappreciates management. Mauricio Ramos, who did come from Liberty Media and from the John Malone complex of companies, and understands how to run a cable playbook like a la John Malone, and he's doing that in Latin America. And I think the market is totally underappreciating the quality of management. The company just had an analyst day where they laid out really impressive operating cash flow growth numbers over the next few years. plus a focus on creating value for shareholders and kind of finding value in kind of underappreciated, undermonetized assets. And so what we're going to get into is that one of the big reason for the drawdown on the stock recently is that Millicom bought out its JV partner in Guatemala for $2.2 billion in November, but unfortunately their shareholder base is not comfortable with a 4x levered company, and so basically a lot of their shareholders are pushing Millicom to raise equity in order to reduce the leverage, and that has created this unbelievable overhang on the stock that has pushed it down for basically non-fundamental reasons, as people are kind of front running it. But it's going to be done in a rights offering, and so existing shareholders will be able to participate in that and will be able to maintain their stake as the company releases its as the company raises equity. So what is Millicom? So Millicom is a leading wireless and cable company in Latin America and South America. If you look on this graph here, in this picture here, it shows Millicom's largest markets. I mentioned Guatemala, where they're the number one in mobile, they're the number one in broadband, and they're the number one in TV. That's their largest market. It's a very attractive market. But also, so the other markets to consider, Panama's a big market where they're also number one in all three. The one where they're not number one in all three is Colombia, and it's the most competitive. It's the one that's had the most currency drag on the company over the years. But I think a lot of things have changed in Colombia over the last, call it 3 to 5 years, and Millicom's in much better position to compete there. So just think of them, they provide wireless and cable broadband services in these countries. They operate, as I'm going to discuss, in very concentrated markets where they're in most of their markets number one and number two in the key verticals. And there is a big difference between them being the number one player and being the number three player in terms of profitability. So this would be suggestive of the fact that Millicom is very profitable in these countries. So they operate in growing consolidated markets. So the populations in these markets are growing. The penetration of 4G and broadband is very, very low relative to kind of developed economies. So you're talking about 4G and broadband penetrations like 20 to 30% versus much, much higher in the US. So I'm not saying these countries are going to get to where the US is in 5 years, but there is a long-term growth trajectory as people adopt the technology. And what's really important, I think, whenever you're looking at wireless and broadband players, is the competitive set. And so if you look at this chart here, basically in most of their markets, the share of the top two players is greater than 80%, or in mobile, and then higher than 70% in fixed and broadband. So what that means is that you have, in most cases, a duopoly, or in some cases an oligopoly, rational pricing. The leaders here are Telefonica and América Móvil and Liberty Latin America. So we have companies, much larger companies that have rational capital allocation processes and pricing strategies that are that make these very attractive markets from a stability perspective. Maybe the economies have ups and downs, but in terms of the competitive environment, it's traditionally been pretty rational. It's been a tough few years for Millicom. I mean, I think Viasat's had its number of external, what in the world is going on issues, kind of off the spreadsheet issues. Millicom has had a number of those as well. It started in 2019 when Kinnevik, which is their largest shareholder, decided to distribute 37% of its shares. So Kinnevik owned 37% of the company and decided to distribute its shares to Kinnevik's shareholders. Kinnevik is a public company in Sweden. And so it created a huge overhang on the stock, and it established a Swedish shareholder base that may not actually care about a Latin American cable and wireless company. And so it's just been an overhang for a long time. And I think, Millicom would benefit massively if they could continue to build, get those shares in the hands of kind of more North American and South American investors who understand the opportunity better. Of course, 2020 was the year of COVID. I mean, every country had a different experience with COVID, but the lockdowns in Tigo's markets were quite severe. And as a result, EBITDA and free cash flow were really negatively impacted. And then 2021 was a solid year of recovery as there was a bounce back in their markets. Tigo invested heavily in wireless spectrum, especially in Colombia, and passed a lot of new homes for its cable business, which basically lays the groundwork for growth in the fixed broadband business. But the investment was made and you kind of monetize that over a period of time. So regardless of that, Millicom continues to invest, but we saw a nice rebound in revenue and EBITDA. And so just like Viasat had the what I'd call the Inmarsat moment, Millicom had the Guatemala moment where they owned 55% of the Guatemalan JV. Their local JV partner just woke up one day and said, "Hey, it's time for us to get out of this." And it was such a no-brainer of a deal, given the multiple 6.2 times EBITDA, given the 50% EBITDA margins in this business and the solid cash flows. It was just a no-brainer idea. And they were the only buyer. They were the logical buyer. This is an asset. This is not like buying into a new market. It's not like they went into Chile or something like that, or Peru. This is the business they already knew well. They were the majority shareholder, and so buying it, there's no integration risk. We don't know the other side risk. We don't know the market risk. They know this asset really well. And so when you're paying 6.2 times EBITDA for a business, such a good business that now you can control and maybe do things in terms of investing that the family that they were working with, on the other side may not have been willing to do. It was just a no-brainer. But the issue is, as I mentioned, they have to raise equity via rights offering to get to about 3 times leverage. And that has been the overhang on the stock. So what's really to like about Millicom? There are really no in-market competitors spending like Tigo is to pass homes and cable. So they are really going to be, by far the number one player in fixed broadband. And over time, as the mix of broadband versus wireless skews more towards broadband, we think this becomes more of a recurring revenue business versus kind of a prepaid wireless business. And it's just a fact that cable companies trade at higher multiples, especially relative to prepaid wireless businesses. And as I mentioned, the broadband and 4G wireless penetrations in Tigo's markets are much lower than in developed markets. So you've got that room to grow. And the overhang has crushed the stock. I mean, the stock was about 35 when the no-brainer Guatemala deal was announced. It's somewhere around 24 today. The valuation, which was already cheap from our perspective, has become totally distressed and basically dislocated given the this looming rights offering. And so it trades under 4 times EBITDA, which you can argue that it's an emerging market telco wireless broadband player. We just think and that has currency risk and all these things, but we think it's so more than priced in. It's almost ridiculous at the current valuation. And management, at the recent analyst day, highlighted how they're focused on finding ways to create shareholder value. And they're going to continue to invest in spectrum and build, the broadband infrastructure. But they're also talked very openly about monetizing their tower assets and their Tigo Money payments business, both of which don't get any credit from investors. So how do we value Tigo? Stocks are around $24 today, 2.4 billion market cap. Enterprise value is much higher because there's a fair amount of debt. This is, the reason for the rights offering. So on our DCF, I'm not going to go too deep into this, but just to give people, as this is kind of like a flyover of Millicom, we think it's worth around $58 on a DCF. That assumes they issue 21 million shares in the rights offering. We put on 9.5% WACC, which I think is probably pretty conservative, but maybe justified for a Latin American telco. And then, 4% NOPAT growth after year 5. And so those are pretty conservative estimates, especially given the company just released numbers suggesting that they think they can grow operating cash flow at a 10% clip over the next few years. On a multiples analysis, we valued on 2024 numbers, gets you around $57. So about 2.4 billion in EBITDA in 2024, putting a 6 multiple on there. Where did we get that? We're basically doing a sum of the parts kind of analysis where we value the cable around 8 times and the wireless at around 5 times. The weighted average multiple, if you just take the relative percentage of EBITDA, gets you a 6.4 multiple for Millicom, and so we're even more conservative than that. We put a 6 on there. And so that's a $51 value for the core business, and then they have a JV in Honduras, which we also valued around $6 per share. And none of this assumes any excess value for the towers or Tigo Money. So the risk in short point, obviously, equity dilution that comes from a rights offering. In order to participate and not be in order to not be diluted as a shareholder, you have to participate. So that means, you should be almost agnostic about it if you participate, but that just means you have to put up some more of your capital to maintain your position, and maybe you don't want to put more capital. And then if you don't participate, then you get diluted. So it's something, especially for someone who's a shareholder or can think about being a shareholder, something to think of. Currency risk is always an issue there. The one thing about Millicom is a lot of their economies are dollarized or dollar pegged. And so really it's Colombia, which has just seen a huge deterioration in the value of the peso versus the dollar. And that's been a drag on Tigo's earnings for a very long time. And that can continue to happen. Obviously, these are emerging markets and all kinds of things can happen. Obviously the Russia-Ukraine thing being an unfortunate off the spreadsheet example of what can happen. The leverage profile, obviously even 3x levered for a Latin American telco with a prepaid business that can be kind of fickle and kind of very economically sensitive. That's something to think about. Further M&A risk, right? They did the right deal with Guatemala, but they levered up in a way that a lot of people weren't happy with, and now they have to do a rights offering. So that's something to consider. Plus, there's integration risk, new country risk. There's all kinds of risks associated with going into new markets in Latin America and South America. I think the big one, and we hear this all the time, is that Tigo will never trade at a higher multiple because of the market it sits in. We think that's probably true. It's never going to trade at where Charter trades at, but that doesn't mean that it can't trade at 6 times, which for the quality of the business, which is amazing. It's a duopoly. It's growing. It's got growing populations. It's got pretty stable EBITDA margins and cash flows relative to a lot of other businesses, but because it's in emerging markets, it just gets this discount. So I'm about to flip it over to Q&A, but I just want to share some resources. As I mentioned, the Compounders podcast is a good source of information on the way Cove Street thinks about the world, but also on these two companies. So I've linked to my 2 interviews with Viasat's executive chairman Mark Dankberg. The second one was all about the Inmarsat deal. So we spent a lot of time in this discussion talking about Inmarsat. So if you're interested in that, I'd highly encourage you to listen to my conversation with Mark. And then I also had a fabulous interview with Mauricio Ramos, who's the CEO of Tigo. And he talked a lot about just the value of having a bundled strategy and bundled product set where you can offer broadband, wireless, pay TV, and to these customers, and the margins associated with being able to create a triple play or a quad play in these markets. And so that's he does a way better job explaining than I do. So I highly encourage people to listen to that. And then contact me anytime if you want to discuss these companies or any other thing that Cove Street owns. B. Claremon at covestreetcapital.com, or you can follow me on Twitter. I'm relatively active on Twitter, especially regarding the podcast. You can follow me at Ben Claremon. And with that, I will flip it back for questions and answers. Thanks for listening.
All right. Thank you so much, Ben. The first question we have is in regard to Viasat. It says, yep. Viasat's leverage was increasing even before the Inmarsat deal, and now the debt levels are going to be even higher with this acquisition. Is that a concern?
So let's just talk about that dynamics here. But so I'm going to take it outside of the satellite realm and talk about, let's just say you're a real estate owner, and you'll understand the analogy as I go into this. So the day before, let's say I'm a real estate developer and I'm building a new office building, and I take on a construction loan from the bank, and the day before my office building opens to be able to be leased, I look levered, like I can't cover like I'm barely covering my interest expense if at all, and I look like how could this possibly be something that anyone would invest in? Well, what happens is you start filling up the building, you pay off the construction loan, you sell the building, whatever it is. But so that's really what happened with Viasat, is that they were building 3 satellites simultaneously, all of which are either in a hangar about 2 miles from our office, about ready to be shipped to Florida to be launched, or in a different stage somewhere where in Phoenix where they're physically building the thing. And so so the analogy is they've built 3 buildings that have no tenants in them that will be kind of up and running over the next year and a half. And so assuming that they can fill up those buildings or those satellites with tenants, like the leverage is going to look a lot better. And the other thing to recognize is that they're issuing a ton of shares, to defease some of the into Inmarsat to defease some of that leverage issue. So we think that leverage will start to come down. We think this accelerates their path to cash flow break even because of the just significant investments they've been making. And so if free cash flow per share is 30 to 35%, 35 to 40% higher than it would have been before the deal, then that would suggest you leverage levels will come down. But I'm not going to dismiss the question. It is something we think about all the time. It's something we talk a lot about with the company. There's a trajectory to becoming free cash flow, majorly free cash flow positive. But at the moment, while the satellites are sitting there in hangars and being in production, and all of that R&D cost is being expensed and all that CapEx is going out, right? You're literally burning the cash. And so you're hoping that when the satellites are launched, you fill up those buildings really quickly, and they're full of happy tenants, and then all of a sudden the dynamic that you highlighted kind of goes the other way.
All right, perfect. Thank you so much for that explanation. You touched on this briefly, but another question is they're wanting to know what currency or foreign exchange concerns should an investor look at in regard to Millicom?
Yeah, so it's a good question. It is something that has been a drag on profitability, especially because of Colombia. My colleague Eugene always likes to joke that they've grown tremendously in Colombia, but because of the devaluation of the peso relative to dollar, their dollar growth has been basically zero. So local currency growth has been great, dollar growth has been zero. And so that's been really painful for Millicom shareholders. But if you look at other markets like Panama, if you look at what's the other one? We look at Guatemala. Like a lot of their economies are dollarized, and I don't have the number in front of me, but I think they say like 80% of their markets are dollarized or dollar pegged. So you don't have the currency risk there. It's really Colombia, and that's been the drag. And so as an investor, you have to get comfortable with the idea that they're operating in Colombia, which is their most competitive market. It's the market where they have the worst position relative to América Móvil, and Telefonica. And so Colombia's been a little bit of an albatross, and so I think to underwrite Millicom here, you have to assume to some degree that the currency is not going to eat up all of the future growth, which is not, I can't guarantee that, obviously, but you also have to believe that they have completely changed their position in Colombia by their spectrum purchases, by some of the regulatory changes that have happened there, the way they're growing their fixed broadband business there. So there's a lot of good things happening in Colombia, but for sure, if the currency eats it all up, it is it's going to be much harder for Millicom to hit their operating cash flow growth targets.
All right, thank you so much. This one is outside of the 2 stocks that we talked about, because they're interested in recent news regarding Holosys, I believe it's pronounced, which recently it's a Chinese company that recently there's rumors of a buyout offer. Do you have any thoughts on that stock? Familiar with it? No? All right.
Never heard of the company, sorry.
Okay, you're fine. Just thought I'd ask regardless. Okay, another question is, how will inflation impact the 2 companies?
No, it's a good question. So let's start with Viasat. So these are knowledge workers, so wage inflation should be a headwind for sure. I mean, my guess is most white collar workers are making more and more money, engineers are making more and more money. So Viasat, especially they're in San Diego, not a cheap place to live. So so that should be a headwind. In terms of things like components and metals and things that are going into the satellites, a lot of this stuff has been procured previously. So my guess is a lot of those costs for the 3 satellites have already been borne and are sitting in warehouses and things like that. But for sure, any new any new deployments of ground stations, depending, especially if you have supply chain issues or chip shortages, it's going to be more expensive. So I think inflation is for sure short-term headwind. But I think you could argue that Viasat has a fair amount of pricing power. And to talk about that, you have to kind of split it up between the businesses. I think in defense, a lot of their contracts, Viasat operates a little differently. Like they don't really have the Defense Department paying for their R&D like the primes do. So they have a slightly different model. But I would argue that their technologies, their encryption technology, their the JTRS Link 16 product, is just so core to what the military needs that they will be able to raise prices over time. They have there aren't a lot of people that can do what Viasat does. So I think that's the gem, the jewel of the defense business that I think a lot of people underappreciate. I think with that comes a fair amount of pricing power. And in Millicom, so the as I think about where the pivot points are there, like I don't know if wage inflation and stuff like that's going to be as big an issue for them in their emerging markets relative to what we're seeing in kind of like a very, very tight labor market in the US. So I don't see that being a big issue. I think what you would be concerned about are infrastructure costs. So whether that's laying fiber, laying cable, depending on what market and what they're laying, component costs for wireless base stations. So any higher metals prices, higher chip prices, those things will be short-term headwinds. But to some degree, again, you're providing very critical services, in wireless and fixed broadband. It is a fact that the ARPUs, revenue per user in Millicom's markets are much, much lower than the ARPUs in the US, just because customers are very price sensitive. So for sure, there would be some limit on the ability to continue to raise prices. But I would argue that they operate in very, very consolidated, rational markets. So if América Móvil is seeing their costs rise, they're going to raise prices as well, right? Like it's just going to be inevitable. So it's not like except in Colombia, it's not like there's 7 different competitors who one won't raise prices and steal share. It just doesn't work that way for Millicom. So I would say on a relative basis, I would argue Viasat has a fair amount of pricing power given the uniqueness of its technology, and then Millicom may be a little bit less. But I think what can offset that for Millicom is just the underlying growth that they're going to see in their markets as 4G wireless penetration and broadband penetration continue to grow. Even if their costs are under pressure a little bit, there's going to be a fair amount of growth, and to some degree, they have a fixed asset base. Once you've purchased the spectrum, once you have the fiber in the ground, like it's a fixed asset base that you can leverage. So it's a mixed bag for Millicom, but I think at the current price, you're certainly not paying a whole lot for. Or whatever. Let me just say, like a lot of bad things are priced in, including some future inflation.
Okay. I have another question here regarding EBITDA. It says Buffett and Munger do not support using EBITDA. Buffett says it's a very misleading statistic. Is it better to use enterprise value to EBITDA instead, in your opinion?
So let me just clarify what Buffett and Munger have said about this. So they say EBITDA, which John Malone basically created as a metric, is an insufficient or misleading measure of cash flow, which I would totally agree with, right? So I would much rather. So we value things based on EBITDA because that's the convention. But and when you're doing a sum of the parts analysis, And so that's a fact. However, we triangulate value, we do DCFs, we do multiples analysis that also uses is EBITDA as well. But we try to triangulate so that we're not necessarily focused on one metric. And so I would argue and that, or I would agree that EBITDA is a very substandard measure of cash flow if you're not in corp. As you're looking at the quality of the business, you should be looking at EBITDA minus CapEx, right? Because that's a much better proxy for cash flow. You can generate all the EBITDA in the world, but if it gets eaten up by, if all your EBITDA gets eaten up by capital expenditures, what gets down to the bottom line in terms of free cash flow for your investors is insufficient. So I hear that. It's why we triangulate value. And that's why we are cash flow focused investors. We can talk in free cash flow yields. That's another way to do it. But to your point, EV to EBITDA is just a valuation metric, and EBITDA is not a great measure of cash flow. So you have to make sure that you are, especially when you're comparing companies, that you are comparing them on a free cash flow or operating cash flow basis, relative to just taking EBITDA as like some kind of gospel that is indicative of the cash flow generating ability of the company or simply the quality of the company.
All right. Thank you so much for that explanation. I think this may be one of our final questions, if not our final one. What advice do you have for investors in this current environment with high inflation and regarding the Russia-Ukraine conflict?
Yeah, I mean, it's a good question. I'll take one step back and say that most investors living today have not experienced an inflationary environment. Unless you were investing in the 70s, you don't have any experience with it. So, 7% inflation, I think, is somewhat transitory. But what is a longer term rate of inflation, given the wage pressures we're seeing, given the pressures we're seeing on scarce resources that maybe take 3 or 4 or 5 years to build up capacity for? So, I would lean towards not 7 compounded over time, but and then some of the transitory supply chain issues, leading to lower inflation than current. But I think we need to be prepared for a higher interest rate world and higher inflation than typically we had been accustomed to. So that's first thing, is just a level set and think about where, what is the inflationary environment look like? And obviously I don't know the answer to that, and I can only speculate, and my guess is as good as anyone else's, but that's how I would look at it. And so how do you invest on that? Based on that, you're looking for companies with pricing power, right? You're looking for companies that have unique assets or technology or market positions that allow them to raise prices at the rate of inflation or higher. So market structure is incredibly important when you're in an inflationary environment, because if there's 10 competitors and you have different cost bases and different geographies, and one competitor doesn't want to play the game and they can steal share by not raising prices, that is a big problem. And so what I would like about something like Millicom is that they operate in a lot of duopolies and oligopolies with really rational competition in most markets. So market structure is something to really focus on. I think the corollary to what you're talking about is what interest rate environment we're going to be living in. And I would just argue that in a higher interest rate environment, very speculative assets are not going to do well. And obviously I'm not saying anything that's surprising to people, as a lot of speculative things have especially in the quote unquote growth world, or in high multiple stock world, have come down precipitously. But I think there still could be a fair amount of pain if we're talking about 4% 10-year rates over time, right? Which is not a crazy number. I remember back in 2007, you could get 5% interest in a year in a 1-year CD, right? And so a 4% 10-year is not a crazy number relative to where we come from. So, I think that's as you're thinking about valuing companies and you're thinking about what's a fair valuation for anything, I think expecting higher interest rates and increasing your hurdle rates for investment, in conjunction with that, is important. And I'll finish just briefly on the Russia-Ukraine thing. I certainly don't want to be flippant, and I don't want to pretend like things are great, and that since Viasat could potentially benefit from this, it's a good thing. It's absolutely, this is a tragic thing. I think it is, it is shaking, the post World War II kind of order that had been created, and so there's all kinds of things that could fall out from it. I can't tell you how to invest with this in mind. There's all kinds of tail black swan-ish events that could, make all of the comments I'm making, that I'm going to make, are completely moot. But I will say that when there's a lot of fear and a lot of uncertainty and people are running for the exits, that can be an opportunity. And so I'm certainly not going to suggest anybody look at investing in Russian debt or Russian securities. However, there are companies that trade in the US who have businesses in Russia, who have operations in Russia, who have manufacturing in Russia, that may potentially be impacted in the short run by this. And I just look at it in that, like, supply chains will adjust. Unless you're sourcing only supplies that are very critical to Russia and can't be made anywhere else, supply chains will adjust. Consumer companies will build things else, make things elsewhere. And maybe, the thing about Russia is this is a very small percentage of the global economy. And it's not a big trading partner with the US. And a lot of our companies have some exposure to Russia, but it's really, like, very minimal. And so the question is, like, does this expand? Does it involve other countries? Does all Eastern Europe go into war? Like, those are much worse events. But if it's kind of contained to Russia, and you look at companies, and I'll highlight one, which is IPG Photonics. IPGP is a stock we own, that, just the founder was Russian, and the company has a low-cost manufacturing base in Russia, and the stock has been crushed as a result of this. I look at that as a secularly growing business with good management and, incredible margins and returns, that just happens to have a business in Russia. And people have run for the exits. And so that's where I would look for opportunities to lean in. I think consumer companies, we've talked a lot, we own Skechers, we own Tapestry, both have been hurt as a result of a kind of think of a fear of, what does the consumer world look like, consumer discretionary world look like if Eastern Europe is at war. And so we've been buying more of those two, because I think we're leaning into, this being, potentially a transient thing, or at least contained as it relates to what the companies we're talking about. So, again, I think, I was just listening to Howard Marks from Oaktree on the Richer, Wiser, Happier podcast. And he said something, in 2008 that still resonates today, is like, if the world's going to end, then it doesn't matter what you do, right? So you can, whether you invest or don't invest, doesn't matter. But if the world's not going to end, you have a fiduciary duty as an investor to protect your clients and to make money for your clients. And so, you should be taking measured risks, buying things that other people are discarding, and leaning into uncertainty, and not worrying that we're going to go to nuclear war and the world's going to end, because if that happens, then none of this matters anyway. And let's knock on wood, that's not a high probability, not a high probability outcome. So in summary, look for opportunities to be smart and take a little bit of risk, assuming you have a large margin of safety, by companies that maybe are not directly, impacted or directly in the line of fire, but kind of on the periphery. And I would highlight IPGP as a good example of that.
All right, thank you so much for that advice and the explanation behind it. But that is going to wrap up our time for today. It's been an absolute pleasure to have you on, Ben. Thank you so much for coming on and giving us this great presentation and taking time to answer some of our questions. If anybody missed anything, like I said, there's a full recap of the presentation, as well as Ben's past appearance on Value Investing Live, available on YouTube as well as on Guru Focus. That's all the time we have for today, so we do wish you the best with all your current and future investments. See you next time.